back to the Chiro Money Show, where we help chiropractors make better financial decisions so they can build stability in their finances and a lifestyle that they love. We're your hosts, Chris Shield and Scott Campbell of Align Wealth, and welcome in.
Talking Warren Buffett today.
Yeah.
What a goat.
Yeah, this guy's a legend.
He is a legend. We're going to get into Warren Buffett, who he is. If you don't know who Warren Buffett is and his story, we thought it'd be timely to do a little episode on some timeless lessons that Warren Buffett has imposed on the investors around the world. He recently retired at the end of 2025. So kind of the reason why we wanted to do a little bit of not a tribute to him, but just some lessons that we have learned along the way. But before we dive into it, quick comparison to Warren Buffett and Chris Shield. One thing what we've learned about Warren Buffett is that he's a very frugal man. Despite his immense wealth, very frugal. Chris doesn't have the kind of wealth that Warren Buffett has, but Chris is also a frugal individual. Just learned here pre-show that I'm usually the one who's responsible for booking our flights and accommodations when we need to go to conferences and whatnot. But in this case, he had to book his own one-way flight back home from a trip here in the spring that we're taking. And I said, Chris, you know you booked ultra basic, right? Did you mean to book ultra basic? Why ultra basic, Chris?
I don't know, man. It's the cheapest option. I don't need much.
And if you're not familiar with ultra basic on WestJet, like no carry-on, no check bag, unless you buy a check bag, I guess.
Yeah.
No water, no snacks.
Oh, come on.
I was telling Chris, I don't think you don't get anything.
No way.
You get the last spot at the very back of the plane next to the stinky washrooms.
Yeah.
And I was telling Chris too, I heard somewhere that the flight attendants on a WestJet flight, they actually have the right to like mock you and laugh at you. And if they feel the need, they can slap you across the face as you walk to the last seat on the plane. I've heard this. I don't know if it's true.
Wow. I really did something crazy. Well, so as long as Warren Buffett will be proud of me, I think I'll take that.
I think he would be.
Yeah.
Do you think he flies ultra basic?
No.
You might.
I don't think.
You might. I don't know.
I don't think he ventures too far from Omaha.
No, I don't think so.
I mean, especially now at his age, because how old was he when he retired?
95.
95. This dude worked until he was 95. What an animal.
I've actually heard that he retired. So he retired December 31st, but I've actually kind of heard that he's still going into the office. So maybe he's already come out of retirement.
Yeah.
I don't know.
I mean, at that point, man, like if you've been driving to the same office for like 70 years, like it's just ingrained in you. He probably can't do anything differently, even if he tried.
Can you blame him?
That'd be the kind of story where like if you retire and just stop, you just die, just drop dead because like it's too abrupt.
He loves what he does.
Yeah.
He's been known to say that you could pay him in seashells and he would be happy to come to work and continue to do what he does.
Love it. Okay, well, Scott, we better give our listeners here some context because I mean, as in investing and financial planning nerds, we love Warren Buffett. We have heard lots of stories and stuff about him over the years, but maybe for those that aren't as familiar, fill us in. Who is he? Why are we talking about him?
So Warren Buffett's likely considered one of the greatest investors of all time. At least there's a very strong case in a lot of people's opinion as to why that is. And we'll get into maybe some of the reasons why he is considered to be in that realm. He is known for being the CEO and managing Berkshire Hathaway. So again, you might know who Warren Buffett is, but if you're not familiar what Berkshire Hathaway is, it's essentially more or less his investment vehicle. Think of it as like a large holding company where he essentially owns a number of businesses 100% outright. I actually didn't know this, but he owns 100% of Geico. He owns 100% of Dairy Queen. So these are businesses that he holds within Berkshire Hathaway. And then he also owns a number of positions in other companies like Apple and Coca-Cola, American Express, companies like that.
Yeah, so
that's just the tip of it.
So he basically uses Berkshire Hathaway as his way in to invest in other companies. And some of those are like in outright full complete ownership, like Berkshire Hathaway fully owns Geico Insurance. And in other ways where they're like, they hold shares in companies like Apple and Coca-Cola, American Express, the same way that you and I could own shares in those companies, right?
That's right. Yeah. Basically like an investment holding company is what Berkshire Hathaway is.
Yeah. And what's all the big deal about Berkshire Hathaway? Like, we hear a lot about it. Maybe our listeners have heard a lot about it as well, but why do they get any attention? Why do they deserve any attention?
Well, they have a pretty tremendous track record in terms of essentially Warren Buffett and his late partner Charlie Munger, like their performance over what 6 or 7 decades, 60 years or so, in terms of how they've managed their portfolio of investments. To give some numbers to that, between 1965 to around 2024, Berkshire Hathaway stock gained over 4.3 million%.
What?
It's insane. And compare that to the S&P 500, which was around 31,000%, which is not bad at all. But in context, that's roughly a 20% annual return over 60 years. To put that into perspective, if you invested $10,000 with Buffett back in 1965, it'd be worth nearly $430 million today. Whereas that same 10,000 just in the S&P 500, again, great return, only about 3 million. Still great, but yeah, just a tremendous track record. And I think what we'll get into with Buffett, what makes him special and what makes him unique and why people admire him is that he's gone through his journey as the CEO of Berkshire with a ton of integrity, transparency. Like, he's very open with how he invests. He's open to sharing these principles and teaching and being a mentor to anyone who would really take the time to listen. Yeah, today we just wanted to share some of the timeless lessons that he has imposed. Yeah, there's so many lessons we could chat for a couple hours on all things Berkshire, all things Buffett, but we'll pick out a few to touch on today.
Yeah, sounds good. Man, before we do, I know we don't have this in the notes, haven't discussed this, but just this is one of these times where like hearing those returns and then seeing the numbers to them, it just like, it doesn't seem to compute in my mind. And I think I'm all right at numbers. Like, I'm not the smartest person out there, but I'm okay. But like 4.3 million% return compared to a 31,000% return. And so Berkshire returned roughly 20% annualized returns for over 60-year period of time. Whereas the S&P 500, we know from our own past experience and research, is like around 10% per year annualized return. So from a 10% return to a 20% return, that has an end result in like, that's crazy, in $427 million. That 10% difference in return makes up over a 60-year period of time in that example you gave, with starting out with $10,000. Like, that doesn't seem to make sense.
When you think about compounding though, right? Early days of compounding, it's just like that flat line, not overly exciting, but then you give it enough time. That's where you hear the term compounding runs wild, right? Yeah. And that's what's happened with Buffett and Berkshire. Should we dive into lesson 1?
Let's do it. All right. So pretty straightforward one. Simply put, time in the market beats timing the market. So trying to predict when to buy and sell certain stocks or investments, that's kind of what we mean by timing the market, and opposed to time in the market, where Buffett essentially in this case means owning and holding a set of securities in the market and just holding them. So that beats trying to predict the future.
Yeah. I think the greatest asset that Warren Buffett ever had was time.
Totally.
Like, how long he's been a long-term investor for.
Yeah. Yeah. And his story is pretty cool. There's so many different things I can point to, but just to let our listeners know, like, he's always been successful. Like, he's always had good returns, good track record, but 99% of his net worth was accumulated after his 50th birthday. 97% of it came after his 65th birthday. Nothing special happened in those years after he turned 50 or 65. All that happened is we allowed that compounding to work in his favor. It's pretty wild when you think of it. And then to go back to like even before Berkshire Hathaway even started, like, he started investing when he was 11 years old. He bought his first stock. And I've heard, and in some of the books I've read about him, his biggest regret is not starting earlier. He started at age 11 and he wishes he started earlier. Wow.
He actually almost started in like business even earlier than that though. I heard stories of him like at the age of 6 buying 6 packs of Coca-Cola for 25 cents and selling bottles for 5 cents to his friends and whoever was on the street corner, making a 20% margin. And he would get frustrated when people wouldn't just buy the whole pack from him.
Couple other interesting quotes and like things he said in the past. This one I just love. Our favorite holding period is forever. Like when they set out to purchase stocks in a company or shares in a company, they're setting out to do it forever.
Yep. That's simple, right? Like he always says, like he wants to buy businesses that he understands, that he can envision probably being around for the next 20, 30, 50 plus years. And the intent is I'm just going to buy great businesses and hold them to that business forever. Last one here, that another great Buffett quote on essentially time in the market. Someone's sitting in the shade today because someone's planted a tree a long time ago.
Yeah. That's a great one.
Yeah.
I wonder what kind of tree they planted.
That's a good question. What do you think, Chris?
I don't know.
The classic apple tree?
I defer to my wife.
You defer.
For me, horticulture.
Right. Michelle,
things,
the tree lover.
That's right.
All
right. So
what's the takeaway for listeners on this point?
Yeah, good question. Ultimately, having that long-term mindset, long-term approach to investing and staying invested through all the market cycles is crucial. So whether you're an early career associate or established practice owner, and you're looking at succession planning or selling a practice, wherever you fall in that stage of life, consistent long-term investing that's aligned with your financial plan will serve you far better than trying to time the market, predict the future, look at the headlines, try to make educated guesses. It's not going to work in your favor over the long term.
Well, before we move on to the next one, I had a couple great Buffett like little quirks.
Yeah.
And the thing that I really like about Buffett is that he had like such a great sense of humor, like dry humor. And yeah, this little story about his daily McDonald's run. Apparently every single morning, Buffett would make his 5-minute drive from his home in Omaha to Berkshire Hathaway headquarters, about a 5-minute drive. And on the way, he'd stop at McDonald's. And before he left McDonald's, he would tell his wife, Astrid, how the market was doing. And based on whether the market was down or kind of just flatline or up, would directly indicate how much exact change he would need to have put in his cup holder so that he could buy one of 3 options at McDonald's that day, depending on how the market was doing. No credit card, exact change.
So funny. That's wild. Another interesting point there, driving from his home in Omaha to his office. He still lives in the same house. He's lived in it for almost 65 years, and it's a very modest, like,
yep,
I don't know, what 2,000 square foot house or something like that. Like nothing fancy. This guy's the wealthiest man in the world. He could buy whatever he wants, and he chooses to live in the same house.
Yep. I think he bought the house for like $31,000. In today's dollars, what it's worth today is only around $400,000 home or something like that. So,
yeah, crazy.
Yeah. Wild.
It's got an interesting percentage there of home value to net worth.
Yeah, that's for sure.
Yeah.
One you don't see too often.
No. All right. Lesson number 2, Scott. What do we got?
Lesson number 2, keep costs low and avoid unnecessary complexity. Fun story about Buffett. Famously wagered $1 million back in 2007 when he said that he believed that a simple S&P 500 index fund would outperform any collection of hedge fund managers over a 10-year period of time. Apparently one hedge fund manager took the bet.
Only one.
By 2017, only one. Only one took the bet.
There's so many active managers, hedge fund or like other active managed mutual fund professionals out there.
What does that have to say about hedge fund managers when their sole job is to outperform the market?
And only one of them
takes the bet?
Only one of them is willing to participate?
Yeah. It's strange. So by 2017, the index fund, S&P 500, over that 10-year period, 125% return over that stretch, while the hedge fund was somewhere around 36, 37%. So Buffett won by a landslide. So it goes like when we talk about a few things here, when we talk about complexity and just keeping costs low, from a complexity standpoint, the S&P 500, is plain vanilla, just buy the index, keep the costs low. What's the impact on the alternative to that, Chris, that Buffett's talking to?
Yeah, I mean, the biggest difference in, like, if you have a passive approach, own the index versus own an actively managed fund that tries to outperform the index, the main difference is the fees. So you're looking to pay 1 or 2% higher in fees for the same kind of outcome. And that fee compounded over decades is having a significant impact.
Yep.
And I find it quite interesting, right? Because there's kind of this like paradox or whatever with Buffett. Like he himself has bought individual companies and and done so in a systematic way. I wouldn't say he's like your average. He's certainly not your average hedge fund manager trying to gain outperformance in a trickier, sneaky way. His approach, like we've said, is to buy and own holdings forever. So it's a little different, but still he is making educated decisions to buy these funds. And he's done it for over so many years. Yet he turns around now in his age and wisdom and says, that's not sensible. Like sensible approach
for most investors.
Yeah. For most investors, a low cost index fund is the most sensible way to get exposure to equity investment.
That's right.
Yeah.
Regardless if you're a brand new investor or if you have multi-millions of dollars.
Yeah. To the point where he even says, like, he does not recommend people invest in Berkshire Hathaway, his company that has had such great performance. I've heard him say, like, we don't know what the company's going to perform in the future. Like, I don't want people to bet on what we've done in the past. Like, you should just go buy an index.
Yeah, for sure.
And he's even taken it a step further and said, when I pass away, I want the trustees for my estate to put my inheritance 90% index fund, 10% short-term government bonds.
Yep. Keep it simple.
It's quite the equity exposure for a 95-year-old to still want.
All right. Before we move on to lesson number 3, one little other quick funny tidbit on Warren Buffett is his Coca-Cola obsession.
Man, he loves Coke.
Probably something that you and I can't get behind. I don't think we're going to follow suit.
No, we're
with
not
this, but
we're not going to stop at McDonald's every day or drink Coca-Cola. No.
But apparently he drinks 5 Coca-Colas a day. When he was working, he was having 3 Cokes during the day at the office and then 2 more in the evening. Man, that's a lot of Coca-Cola.
I can't believe this guy's still alive with all the McDonald's and Coca-Cola.
Yeah. Apparently he rarely will touch a vegetable. Sometimes he'll skip McDonald's for breakfast and have ice cream instead. Hates, just eats like a 6-year-old. I think there's I'll butcher the quote, but he said something along the lines of, I've looked at the actuarial tables, 6-year-olds, they have a very low rate of passing away, so they must be eating something right. I'll just eat like a 6-year-old.
That's hilarious.
Again, his ridiculous dry humor.
Yeah, love it. Cool.
All right, Chris. Lesson number 3.
Lesson number 3. I think this is the biggest one, honestly.
For sure.
Behaviors matter more than strategy. So Buffett has succeeded not just because of his great analytical skills, but because of his temperament, how he reacts when the market changes. So he has remained calm during crashes. He's constantly resisted following the crowd and made decision based on value rather than emotion. Underscore his ability to be fearful when others are greedy and greedy when others are fearful has really separated him from the pack.
That aspect there, like be fearful when others are greedy and the vice versa. I remember hearing that at one point, and that's always stuck with me. Totally. In terms of when everyone's so optimistic about the market and it's like there should be reason to pause. Not that you're going to make any sort of rash decisions and try again go back to time the market or when to get in, when to get out. But yeah, he has this great ability just to be even keel, and when markets do crash, he's often sitting on cash and makes educated decisions. When the market goes down, he sees it as an opportunity to buy a lot of companies at a great value at a great price, and big part of why he's done so well and had those 20% returns on average over 60 years.
Yeah, totally. Yeah, there's so many different like human behavior elements we could bring into this and that he probably would speak to and has showcased over the years. But ultimately patience, I think, is the biggest thing here. And he's got this great quote that says, "The stock market is a device for transferring money from the impatient to the patient." So if you want to be impatient, the stock market's not the place for you, because you're going to transfer some money to guys like Buffett that are willing to be patient and be sensible.
That's right. Yeah. One thing to always remember when it comes down to it, good times and bad, whenever there is a trade to buy or sell, there's always a buyer and a seller, right? There's always 2 sides to every trade. So when things look scary in the market and people are selling to cash, guess who's on the other side of that transaction?
Someone.
It's guys like Buffett. Right?
Yeah. Yeah.
Friend of the show.
Friend of the show, Buffett. Taught us everything we know. I think this is a good kind of, there's a couple lines here that you'd written down that summarizes the way Buffett looks at investing. And that those are to own quality assets. Don't own junk, own good stuff. Keep your costs low. Let the magic of compound interest do its work for you. and then control what you can control. That's your most important part. Control your savings rate, your investment costs, your tax efficiency, your behavior during market volatility.
Does that make you think so much about think over time people have thought of using a financial advisor to gain an edge?
Yeah.
Can they outperform the market? I'm going to move to an advisor because you're going to give me some great returns. But if we take Buffett's approach and take a sensible approach to investing, buy the broad index, invest for the next, 3, 4, 5 decades, let's focus our time. Like for us, what we like to focus our time on is everything you just mentioned. Let's focus on what we can control. Your financial plan, your tax efficiencies,
your savings rate
along the way, your savings rate,
debt repayment,
all the other things. Yeah.
Optimizing life, making sure you're going on holidays, enjoying time with your family, friends, making memories.
For sure.
Yeah.
Even if it's on an ultra basic flight. Yeah.
That's fine. Yeah.
Either.
As long as you're going to beat Scott at a High Rocks or ultra marathon event, it's all fine.
That's right. Yeah. That's right. Yeah. Fair point.
Love it.
All right. Well, anything else you got today, Chris, on that point?
I think just to leave our listeners with this, that successful investing, it's not about complexity, trying to time the market, chase performance. There's no one out there that can get you an edge on any of that stuff. It's about simple principles that are executed with discipline over long periods of time. That's how to win at investing.
Yeah, for sure. Cool. Well, we'll leave it there. You're heading out to Mexico tomorrow?
To Mexico.
Enjoy the sunshine.
Yeah, I'll be a little bit more tan next time we record, hopefully.
It's not hard to beat me in that department.
That's fair. Yeah.
All right. We'll see you next week. Thanks for tuning in.
See you guys next time.
All opinions expressed on the Chiro Money Show are for educational, informational, and entertainment purposes only. Nothing on this podcast should be considered financial, legal, accounting, or tax advice. Always consult your own team of licensed professionals before making decisions about your finances.